Great. So let me start with some introductions and we take that from where. Great. Yeah, hello everyone. We're excited to welcome you to our next version of Nikhil's Investor Lounge. We're gonna come very soon to our guests, but before we do, we just want to give you a brief introduction about DoDash, what is this all about, and that you just learn why we have these sessions and what you can take from that. Now, first, why do we even exist? What is DoDash all about? The biggest challenge for most startups is the access to capital investors. Less than 1% of startups ever raise. Thank you, Ankit. I would ask you please to mute yourself when you come in. Again, so out of this issue that less than 1% of startups ever raise any funding, the idea for DoDash was born to really help both startups and investors go through the fundraising journey. For that, we are launching our investability platform very soon. On that platform, you're able to connect with investors. We will help you, guide you through the whole fundraising journey from the data and documents you need, being guided, getting feedback from the system, and actually able to find the right investors, and then go through a further journey. So we'll be there for you for the whole fundraising journey from start to finish. You can sign up now on the dodash.com, which I advise all of you to do tonight, because the ones who do it in the beginning will get free access to don't miss the opportunity. Now, in addition, we also already launched our DoDash community beforehand because we saw the need for education and support for the founders. That means investor-focused sessions such as one we have today, pitching events, other expert sessions, but also sharing knowledge, educational content from blogs and video courses. So you can get them all under the DoDash community and the community.dodash.com. We are also supported by a large number of partners. Now you can see the overview here, and the ones below also offer certain startup credits, discounts also to all of you. And we want to highlight one of these partners, which is DataWorld. So DataWorld offered 50% discount on an annual package for all the attendees here tonight. And DataWorld allows you secure and organized access to data files. Now imagine as your digital tool, instead of sending like email attachments, not knowing where stuff is, you'll get further analytics, you have the security. So check it out. I will put the link in the chat below after I'm finished here with that, and then you can check it out. Yeah, if you have more questions on DoDash, just reach out to me, my email, or just write me a message here. I will be here throughout the whole session. And with that, I would give it to Nikhil to introduce himself and also our guests.
So in India, we have a tradition, and today we have Indian guests. So I would rather start with the guests and then come back to me. So I'll start with you, Radhika. Please go ahead, introduce yourself, tell us about something about yourself.
Yeah, sounds good. Thanks. I think first of all, thanks for having us within. And great learning about DoDash as well in the beginning. So I'm Radhika. I work for the investment team of a fund called Blume Ventures, which is one of India's leading early stage venture funds. So we're a tech investor, sector agnostic broadly, make investments anywhere from about 500K to about 2 million or so in our first check. At Blume, I look at all things consumer, so education, healthcare, HR, e-commerce, or as I like to put it, things that don't need an engineering degree to fully understand. Before Blume, spent a couple of years in a couple of different countries doing a combination of consulting, finance, lots of confusing things, and then finally found my calling at Blume and moved bag and baggage across the world to join. So that's about me.
Thank you, Radhika. Jitesh, we would love to hear something from you.
Thanks, Nikhil. Nikhil, thanks for having Radhika and I here. Just to add to what Radhika was saying, Blume's been in existence for about 10 years. So we're actually celebrating our 10th year currently, and it's been a fun journey. I don't have a as colorful cross-country background as Radhika's is, but broadly speaking, here at Blume, I work on the platform team. So my main role, in fact, starts after the investment. We believe in really going deep and helping out our founders with way more than just capital. How I landed up here is a funny story. I used to work at one of Blume's portfolio companies, leading sales and It so happened that we just sort of did a reverse poach of sorts. I've landed up here through multiple things. I've been a founder before, ran my own SaaS company for about 3 years, which got acquired, and just continued working in the ecosystem post that. And that's broadly how it's been. Specifically, I think I have a weird and massive obsession around aviation and planes, which is often, at least internally in the team, made fun of in a good way. And Radhika's avoiding not to smile about that. But yeah, and just as you know, as a person, I'm just always happy to help. Help founders, help anyone in general, try and spread good karma as we go along. And it's been a pleasure, obviously, getting to know you, Nikhil, and the Dudash team, and excited to be here.
Thank you so much. Thank you. So I'll just take this opportunity to quickly introduce myself. I've been a serial entrepreneur, and then I turned to investing. That's what most of the entrepreneurs do after a few exits. And post my exits, we set up a family office, which started investing in a lot of startups as well as one of the asset class. And then I recognized that there's so much of an information asymmetry. There's so much of problems with the founders. They don't exactly know what investors are looking for, and then they typically resort to what I call as just pray and hope that magic happens. And suddenly they find themselves that there's nobody backing them. So that led me to kind of get back into entrepreneurial space, and Dudash is essentially the result of that. Dudash, as I said, is an AI-driven platform. I think Michael already introduced AI-driven data platform, which guides founders through every step of the way in terms of what are the trust assets they need to put together for them to be able to be seen favorably by investors like Jitesh and Radhika here. So with that, if with your permission, I would set the ball rolling. Is that all right?
Sounds good. That's
Yeah.
good.
All right. So one thing which I would request the entire audience is keep the questions coming. I'm going to take those questions up and ask Radhika and Jitesh on your behalf. And with that, Radhika, my first question is to you. What is the funniest pitch you've heard so far? I mean, before that, I would rather ask you what exactly Blume Venture does. Maybe go a bit deeper into that, and then we go ahead and I'll start asking you a couple of other questions around the funniest pitches and so on, which I kind of,
Yeah, absolutely.
Go ahead.
So, as Jitesh and I started with, so as mentioned, Bloom is an early stage investor. So that means is we usually invest in companies when they're fairly early on, just before, just after PMF is broadly where we like to come in. At Bloom, we have I'm gonna copy Jitesh's line. I'm sorry, I'm gonna steal this from you, but today he said this to me, where an investor is like a partner or a friend more than someone who comes and sits on your board. So I think there's a lot of hand holding that goes into any founder relationship that you have. Especially ones that you come and invest in. So at Bloom, we've built out a very, very strong platform team. Jitesh, of course, is one of the shining stars of that team, where we kind of help founders with anything to do with marketing, business development, further fundraising, HR, their hiring needs, etc. And have a strong belief that so much of your founder journey is just driven by you learning. At almost every stage, every 6 months, you're effectively leading a company that looks very different, a new company effectively. So as a CEO, as a founder, you need to constantly be evolving as well. Your L1s need to constantly be evolving as well. So building out that entire learning practice is how we help founders that we've invested in. So that's more about what we do once we've invested in a company. Before investing, where your question around pitch came from. So yeah, we meet about 2 to 3,000 startups or so a year. Invest in maybe about 8 a year. So you can do the math around what that the universities would call it acceptance rate would looks like. And honestly, that part of my job is probably one of my favorite parts of my job, just meeting so many different kinds of companies every single day, every single week. They span across different sectors, very often span across different geographies. Even though we're India focused, you have founders sitting in different parts of the world and trying to solve problems in India. And yeah, that kind of covers the overview of what we do from both the pipeline perspective and once we've invested in the company. Jitesh can add a lot more on that as well.
I'm just going to add one thing, Nikhil, to what Radhika said. I think just in terms of, just for any of the founders listening in, broadly, we do our investments in two areas. While we're sector agnostic, 60% of our investments happen in B2C, which is basically where you're solving India-specific problems. We have enough chaos back here, and I think it's been made even more interesting post COVID. That's 60% broadly, and the remaining 40% is more B2B, which is basically engineering in Bangalore but for the world. And we're seeing a huge trend, obviously, happening with the Freshworks and the Postmans of the world as that scales along. So we've consistently, in fact, over the last 10 years, broadly maintained this split. That's just an important additional point for anyone on this call to understand on what we look at. We are also heavily thesis driven, which means we generally don't make an investment if we don't have our research around it, even if that means the research being spurred by something happening at that point. A lot of that is also public. In fact, Radhika's done an excellent work around the EdTech thesis, all on our website, and for anybody to view. So just wanted to add that.
That's amazing. So essentially what I hear from you, that you invest in less than 0.8% of the pitches that you receive, right?
Yeah.
Oh my goodness me, founders, make note of this. Actually, you're very right. I mean, from my, I've as a family office, we went through over 4,000 pitches, and 4,000 actually. We not just went through pitches, were probably higher. Over last 5-6 years, we went through about 4,000 companies, and we invested in about 40 of them, so which translates to about 1%, slightly higher than yours. But of course, you are a fund, and you use other investors, LPs' money to invest in the assets. We were using our own. So
Nikhil, just on that point, if you don't mind, you mentioned LPs. I just wanted to also add one aspect, which personally is very close to me as a founder. At least in Blume's case, we're fairly homegrown. So like it's been started from scratch by Karthik and Sanjay, who are the two managing partners. In fact, their initial stories about raising their own fund itself are very similar to how a founder raises for their startup, because it's pretty much similar, right? Why I feel that's important is because the empathy comes in from that point itself. It's very easy. When I was a founder, like it was very easy to look at investors from this pedestal that you're just there because you're there, but the struggle is real on both sides. And more so, especially when the stories are insane. Like, what I've heard where they pitched to like 500 plus people for their first fund. And so the empathy comes there when we are also trying to evaluate founders and be empathetic towards that, because even now that happens with us when we're raising a fund 10 years later as well. And even if you speak to an experienced founder, even if they're raising 100 million, it's still the same process. So I just that point is critical to, I think, understand as the ecosystem also evolves.
Absolutely, I totally get you, because I think this is something which is absolutely important for founders to recognize, that VCs are their friends, not their enemies. But this gives me a great segue into one of the questions which I've been battling, and I thought I was meaning to ask you, Radhika and Jitesh. should founders really care about the VC brand? I mean, think about it. Money is money, right? I mean, how does it matter? Radhika.
Yeah, I can jump in first. I won't forget brand for a minute. I think brand is a very overused, complicated term. Where I disagree would be money is not money. This thought actually came to me when you were talking about how true that most funds have that like less than 1% kind of funding rate, so to speak. The good news is that there is every year a new wave of investors that comes in. So effectively every year there is a new wave of capital that comes in. And when these days in the news, almost every day there's a funding announcement. So clearly there is capital in plenty, not just in the West, but now also in India. So capital is now very, very commoditized. You need to look beyond that and look at who the right partners are, right? These are people that if you're as a founder in it to build for the long journey, to build something massive, legacy building, it's going to be a 5, 10, 15-year kind of journey. That's how long most of these large startups, even in the West, have been building for. So this is not someone that you're just going to exchange emails with for the next 10 years or maybe see once in a couple of months in a board meeting. This is someone who should be as invested in your business, who should have as much conviction in the vision that you're selling, and should feel your highs and lows ideally as much as you. You need to look at who can multiple facets of this. One, who understands you as a founder and your business the best. Don't try and pester funds that don't really have a thesis in that area, because chances are they don't have a thesis in that area. They don't feel very strongly for it. As a founder, you're better off going and working with an investor who also believes that in that area in a big way. Second, pick people who have expertise in that area. So if you're like a founder in a D2C food brand, try and pick partners, aka investors, who've also kind of experienced that space, either through their own work or startups or through other investments in their portfolio. So they have know-how, they understand what works in that business, what doesn't work in that business, and you can kind of leverage their knowledge. So make mistakes at cheaper cost effectively. And then the third is really what comes, everything else is where Jitesh's role plays a big part as well. Pick investors who can open doors for you. Pick investors who can give you the right advice and what doors to be open. So I wouldn't say that it's about brand or is capital. I would say pick a partner that you enjoy working with. And that will be good for your business. And especially at early stages, don't get too drawn by that little difference in evaluation or those very, very nitpicky terms on your term sheet. Think long term. Think about who will get you to that like 1 billion, 10 billion IPO kind of outcome.
Awesome. Awesome. Thank you so much. Jitesh, would you like to add something to this?
I would, in fact, as been through the fundraise process myself, I think I totally agree with Radhika. I will add one thing though. Often when someone's going through this, realities are sometimes different, because often you don't. It's a classic confirmation bias where most of the founders will never get to choose, and that is the harsh reality. So at the same time, I would say, like, despite being on both sides, if you can have an option of not raising, then do that, because that actually, to be honest, brings it bodes well when you're actually going to raise, because not every business is a venture fundable business. It's very easy to look at a funding story and say, I'm going to get funded, and think of it as like a end case. It works both ways. That's one. And I've, like what I was saying, I've seen that with a dear friend of mine who went out to raise a large round, but got only 1/5 of that towards the end, and he sold a company before. So if it can happen to someone like him, it can happen to anyone who's doing it for the first time. So there will be times where you just need the money. In that case, you don't have a choice, but still, I think doing some sort of due diligence helps. You'd rather not scale or not want to scale 10x for the next 6 months than have an investor you can't sit 10 years later, have a drink with, sort of a situation. So it's tricky in reality. I agree with that, because you see the numbers, right? Like 8 out of 2,000, 3,000. But I think the good thing is that the ecosystem is evolving. The sign of a good ecosystem is where a lot of angels come in, a lot of micro VCs are there who will fund on MVP stage, who will fund on idea stage. And that is a good sign of a mature ecosystem. So any form of exits that happen, it's a cycle. And we see that, like, I'll be honest, like there are some rounds that close on WhatsApp in India. It was unheard of before. It's just a sign that, like, that just breeds innovation on its own, right? So I think that's the 2-3 parts that I mentioned here, but I think eventually it comes down to your conviction as a founder in terms of what you want to say. But do, like, certainly I think having good advice or having people who've been there more than just getting the capital often just helps, because they'll just tell you things which sometimes other people will not know, and that also go a long way.
That's a very good point. But while during your conversation, I think during your this thing that you kind of mentioned, that all startups are not really VC cases, and I think that is something which I would really want to expand. I want you to expand. What are really VC cases for you? What are really startups? I mean, not every new business is a startup, and I think that's something, that differentiation, that is something which founders really need to recognize today. And I think that is, can you throw a bit more light on that, you or Radhika, whosoever wants to go?
Radhika, you want to take a first shot?
Sure. So I won't get into the difference between startup or business, but yeah, I'll add to what Jitesh said about not all businesses are VC fundable. A very, very small percentage of businesses in the world are actually VC fundable. I think what unfortunately happens is, because a little bit of the newness of it, because we're so inspired by the Valley in many ways, and because of just the sheer amount of capital involved, in the news you only read about VC funded startups. You only read about, XYZ has raised 200 million at a 4 billion valuation and things like that. And so it's easy to get drawn into that rabbit hole of, oh, this is the only way my business will succeed, and this is what a successful business looks like, which is not at all true. You need to have the two broad principles or thumb rules of what a VC fundable business looks like is, a limited amount of input is able to have output at scale. So a SaaS company or any sort of company built on lines of code is a great example, right? Because a single line of code can actually serve 10 users, 10,000 users, 10 million users. Yes, you keep adding to it to keep improving your product, but your base product will keep serving users at scale. The second is there is some limited element of network effects involved, at least. So every new user that you end up getting is slightly cheaper to acquire and slightly cheaper to serve than your previous user was.
Got it.
So service businesses are a typical example of what would not be very easily VC fundable, because those aren't, you're incurring a very certain amount of cost every single time you serve a new customer. Now, of course, we're seeing a lot of service businesses also becoming productified. So tech is making a lot of these businesses easier to scale, easier to serve multiple customers at much cheaper costs. And so they're now getting VC funded. But we're seeing brilliant businesses being built, bootstrapped, being built on debt, being built on very innovative forms of financing. Now, revenue-based financing is such a big model working across the Western India. So I would first really consider, based on my business model, based on how my growth looks, and also what my ambition looks like. Do I want to build a $1 billion, $10 billion business, or do I just want to build a 10 crore business? And neither answer is right or wrong. It's about where your ambition lies. And that needs to align with your investor's ambition as well. So if you're looking to build a 10 crore business, VC funding may not be the best path for you, because they're on a very different treadmill altogether.
Just adding to Nikhil, to exactly where Radhika left it. I think it's important to also understand two things. I'll rephrase what Radhika said. As a founder, would you want 10% of a $100 million exit, or 1% of a $1 billion exit? The amount is the same. 10 million.
Absolutely.
The first one may not be venture fundable. You have complete control of the company, no external people involved, full freedom, might take longer. And the second one will require a very different thing. I'll add, now that is actually connected to another aspect around hyperscaling. What that basically means is you have to now also understand, and I think hopefully it's going to get better. The moment you bring in a venture capital firm in the picture, you have to keep in mind why they're investing money. Like Blume, for example, most funds are 10-year funds. Now, what does that really mean? If I invest in you today, you need to know when I raise the fund. My responsibility is not to just give you the money and just be chill about it. The real fiduciary responsibility of any fund manager is to return the money back to their investors, and that's over a cycle. And that is a very important aspect on how we will choose a certain business, because we will choose companies who we feel has a higher probability of growing that fast, because the faster they grow, the better, or the faster probability wise we can exit, right? It is the truth. It just never gets talked about. And it's because it's such a long-term game, right? Like at that moment, that's why the numbers are so low from our side, and for any such fund, because that's why those dynamics become important. And that's probably a different session around fundraising strategy totally. But I think that element is there, and the rest, I think Radhika pretty much covered it. And like, for example, I'm just sharing what I wish I did when I was a founder 5 years ago. I never thought of any of these. I actually picked up an investor who, I could have waited. Blume actually was in the consideration and I didn't wait. So those things can become, can be different. So yeah, just want to add that.
But if I could.
Sorry, go ahead.
Sorry. If I could just add to, Jitesh is saying very interesting, where as a non-VC funded company, or as a non-investor funded company, whoever the investor might be, you have complete control over the business. It's an interesting conversation I had with a founder of a D2C startup who's building just completely bootstrapped. And she said, while I have complete control, I own 100% equity and I make all the decisions, it's as important for me to also have a great set of advisors. So for anyone going the route of bootstrap businesses, still try and construct a very solid board, for instance, where you bring in people as advisors who maybe run similar businesses, who A, you look up to, and B, who can give you very critical feedback in a constructive way also. So yes, it's great to have 100% control, but then try and keep that learning element going as well.
Absolutely. I always tell my the people who approach me specifically regarding fundraising, or especially the ones the dream with me kind of scenarios, where the vision seems like it's going to change the world tomorrow, and typically they come back with a proposition that there's no comparable product which exists. That's when I start looking at advisory board, how many advisors they really actually have, so that possibility of enrolling experts actually increases that delta of not just being a pipe dream, rather than it actually lends a bit more likelihood of a successful outcome for the business, probably by a certain order of magnitude. Is that what you're alluding to?
Yes, largely.
Any deviations or any other thoughts around it?
Jitesh, you want to take that? I want to throw that back at you.
No, I think, it's like, I tend to think of it a little more philosophically, where it's like saying that if you really want to solve that problem, you'll find a way. There's something called as a mom test, right? Like, where you try to explain things. I have a very different version of it, where it's subconscious. Like, I stay away from home. I call my mother every day, and I'll do that till the time she's alive, right? And she does that to her mother. Nobody has to teach me this. So if you're truly mad about the business and the problem that you're solving, eventually it will play out. And that answers all these questions. So whether you take an advisory board or this, because what will work for one company will not work for the other.
Absolutely.
Like you need someone who sells on your behalf. You need a tribe, like somebody who will, when you're not there, still talk about your company. Like Nikhil, I remember when the first time we spoke, I remember mentioning two of my friends' startups just because, like, I truly believe in what they're doing, right? So I feel when that's happening, the sphere of creativity just starts to take place. So you'll start to think of solutions or ways to do things. You automatically become more persistent. It's this madness required, and that will eventually solve. Like today, there was a merger between one of our portfolio companies, Exotel, and another company, MAO, which is in the contact center space. The story of Exotel is insane. There is 300K of capital 10 years ago, and they then built a 10 million ARR business. They got zero investor love in the meanwhile, zero.
Wow.
Their next round was last year, which was 8 years after their existence. It's unheard of in the venture space. But the founders in between decided, hey, I raised a 300K round. I'm not getting the investor love. I will turn this around because I believe in the problem so much that I'm just not going to leave it. Right. And there are enough and more examples. Like it just looks so rosy on the outside, again, because you're just hearing about the winners. Like I think there's so much deep inside and out there, and we see it like almost every day. I can't even empathize there. So I think ultimately that sort of takes care of itself. And as I said, like it's a little philosophical view, but that's my personal belief.
This is really very interesting because I've been an entrepreneur all my life, and if you ask my friends, my cousins, or whosoever, I didn't have a very great education. I had pretty decent education, but not really good grades. And there was this obsession about entrepreneurship. I just didn't want to. Probably it started with, I didn't want to work with somebody. I just wanted to work for myself, and probably it started from there, and it just kind of, it just becomes a habit. So we've been talking a bit about the mindset here, and I call it entrepreneurship is really there is a certain entrepreneurs are by any stretch of imagination delusional, at least in the beginning. Probably the wisdom comes in after you've been put through a school of hard knocks. But what, in your opinion, and this is, I'm talking about the extreme side, a moderate philosophical side, what makes the entrepreneur's mindset different from the others? People, specifically people who would like to live in the comfort of a paycheck.
I can go first, or
Go ahead. Since you've been a founder, you should go first.
I think, like, so for me, it's generally just curiosity. Like, I think just being curious about why a certain thing is the way it is probably the first step itself. And that's just like, if I have to look back into like some of the founders who I work with, or even friends of mine who are building successful businesses, like for me that comes first. I think there's a respectful way of doing that as well. It can get too much also, where it sometimes isn't necessary, but I think that comes first, because ultimately you're solving problems, and to solve problems you have to go deep enough. To go deep enough, you have to be curious enough. And I think that itself, like I'll be honest, like in my 3-year journey, I think I learned more about myself. Forget the business I built. I think I just learned more about what works for me as a person, what doesn't, and things like that. So I think that for me, if I had to choose one, that would be just too high up there, because again, philosophically, that will take care of a lot of the other things.
Okay. Radhika, please go ahead and add something you would want to add to this.
I have two. One is slightly more extreme, one is more normal. And the more extreme one is, I think the best founders just think of the world as a very, very different place, or the world that they're trying to create as a very, very different place. And I'll narrate two very short instances. One was, ever since I moved back home, whenever something like small gets over at home, I'll tell my mom it's not a big deal, we'll just dunzo it. And my mom will get very paranoid by the thought that, like, what do you mean you will dunzo like a small box of dahi? And I said, no, that's the purpose of dunzo. What do you mean? So products like this change the way we operate on a day-to-day basis. Her generation, forget hers, like 5 years, 10 years back, even I was not used to that kind of convenience, right? And the second was a conversation with Karthik at Blume, one of the founding partners of Blume, a while back, where we were talking about a certain company, and we said, this, like, it just won't, it won't, this industry can't change. There won't be adoption. We don't think it's a good idea. And he said that's the worst idea. That's the worst way to look at a company, because our jobs are to help founders change the way things operate. So you can't just say this is status quo, this is modus operandi, and that's why the startup won't work, because that is the purpose of a good startup. So one is the best founders just think of the world that they're building as completely different from what exists today. And the second factor is just solid grit to be able to make that change. The ability to say that if I need to stay awake for 48 hours to solve this problem that I'm facing right now, I will do it. So I think that combination is just what makes founders so, like your point, delusional, but also just the most lovable people ever.
Awesome. Thank you. Thank you so much. I mean, these insights are probably very important for us as founders who are trying to raise external capital. This is going to help. Keep your questions coming in, friends. So I'm going to probably go onto the lighter side of the investment. What has been the most ridiculous pitch that you've heard in person or read, which kind of which has stayed with you, but it has been absolutely ridiculous?
I can start. There have been some very interesting pitches, like in terms of what they're trying to build. I won't call them ridiculous, because who am I to call them ridiculous? But like, I found some very, very interesting. I know one of the early companies that I met and I just joined Blume was something in the pet dating space, so like Tinder for pets. And I'm not a pet parent, so that of course was lost on me. But I was very fascinated. I'd never seen anything like that. In a pre-COVID world, I've met companies trying to build like e-darshan or e-puja. So for those of you not familiar with Indian norms, it's basically like a online version of praying at a temple. So I've met some very interesting models. The funniest pitch, and this maybe drives back to your point of just crazy delusional founders with solid grit, was a founder who so even in a pre-COVID world, we would do our first meetings with founders on Zoom, because we do like 10 a week. Um, and after my constantly letting this founder that, no, we're going to do a Zoom call, don't come to the office, they still showed up to the office. And I was so glad they did, because I absolutely loved what they were building. I loved talking to them. And realized after they'd left like an HDMI cable in our office. And eventually, after several meetings, kind of became friendly with them, and suddenly remembered that, hey, you guys have left this cable of yours in the office. And they later told me that, yeah, we left it on purpose, so that just in case you stop responding to us, we can swing by. And our excuse would be to pick up the cable, but then we can like start up another conversation with you guys.
Smart.
So that's a very unique way of hustling the system.
Smart. That's smart. So guys, make sure you have HDMI cables in your bag when you go to an investor meeting next. Incredible. Thank you. Jitesh, what about you? Tell us something something really funny about what you've experienced or encountered in your journey so far.
So I don't unfortunately see as many founder pitches as Radhika does, but I think I'll keep this on a lighter note. I think for me, just in general, I spend more time around crazy ideas. So like the most recent one is a founder wanting to charter a jet, just because. And as an example, right? So I deal with more of those ideas, and there's some like, again, like another one, for example, I remember, which sounded really funny at first, but we executed that immensely well. Another one of our founders, when COVID hit, like I remember I was actually in Goa March when this call was happening, where there was a rumor of a lockdown, and this founder said, hey, I need to pivot to online. And if lockdown happens, I'm basically screwed. It's not a ridiculous idea, because none of us, who would be traveling so much, never thought that lockdown will be like this. But in 10 days, that company implemented and moved completely online, like
Wow.
in 10 days.
Wow.
And they're a B2B2C company, right? So where they were completely servicing physical, like doing that in a more physical environment. So that sounded extremely crazy to me at the point when I was having this conversation, because I was hosting, like I was in Goa for work, hosting a set of VCs, and in the middle, I got this call. I'll take a founder call over anything, I think, after parents. So this call was happening, and when I look back, I wouldn't have thought of this. Like, I think the way, the conviction the founder had, I actually told him that, listen, you're crazy. This can't happen. He made it happen. And there are enough of these. It's not as I said, doesn't classify as a funny pitch, but it is enough of these where you just sit back and you're like, this is insane.
That's execution on steroids.
It's insane. Yeah.
Yeah, awesome. So awesome. I mean, then it just brings me to one last question before I start picking up audience questions here. How should the founders reach you? Radhika, I'll start with you.
You can email me at radhika@blume.vc. I must admit, Nikhil's last LinkedIn post spoke of your last guest giving out their email address. So I feel a certain amount of pressure to do that. No, I'm kidding. No, you should just email us. We're all most of the Blume team is first name at blume.vc. We also have a thank you, Nikhil. We also have a pitch form online that we every single startup that applies there gets reviewed by one of my brilliant colleagues, and it reaches the right place. If we're looking to invest, you'll get an email. If we're not looking to invest, so we're actually, as far as go, we're pretty easy to reach.
Great. Thank you so much for your email address. Then, of course, we already know Jitesh's email address, but I'm sure my colleague has already done the job. But, you could do better than that. You could go through
Phone number.
Dash. And you know what?
Absolutely.
Not only that, DoDash will even add its own layer of report around it, and you'll know exactly how easy or difficult this, or how this startup is going to perform potentially, or likelihood of performance in future. So that's awesome.
Sorry, Nikhil, if you don't mind me adding, to the content, the contact bit. Often if you email us directly, especially when we don't know you, there's a chance of emails getting missed. I just want to be realistic about this. Is why a pitch form exists. So, like, I've heard enough number of times saying, hey, if investors don't reply to our emails, it's not that we don't want to. It's just that in the order of things, like, there will be layers to when things will happen. And is why a pitch form makes more sense. So you can always reach out to us one-on-one, but please think of it the reverse way as to why should anyone, the same applies to you also. When you're, let's say, when someone reaches out to you, why should I spend those 5 minutes reading your email and actioning it versus anything else, right? Like, it seems non-trivial, and I want to make sure that this caveat is added. And we try our best to respond to all, but there are times where enough number of founders have reached out directly, despite us saying that, listen, please reach out on the pitch form and things like that. And then, they may have a bad experience and so on, which is never the intention. So I just wanted to add this as a practical layer.
Difficult to get.
Yeah.
That's all. That gives the perception that I mean, the investors are difficult to get.
They are easy to get, but at the same time, like look at the numbers, right? Like, I can literally do a screen share of my inbox, and so can Radhika. So always reach out, but there are often times where we will take, like, let's say 24 hours, 28 hours to respond and things like that. So that's the other thing I want to add.
So I'm going to start with some of the audience questions, and brace yourself. They're pretty interesting questions here. You're going to spend the next 15 minutes taking their questions. So there's one gentleman called Krishan Shah. He says, I'm unable to get sufficient traction in my SaaS startup. And also, I'm a non-tech founder with no CTO in the company. What should I do? Radhika, this question is for you.
Actually, I think Jitesh is better suited since he's run a SaaS company before.
Okay, Jitesh.
I'll take
you
that.
go.
I mean, honestly, there isn't enough information for me to truly answer this. The two things can be completely unrelated. You're not having a CTO and not getting traction. If I was in this position or were to give an answer, assuming Christian, you're hearing this, is, I mean, I think the logical question is to understand what are the things that actually is causing the problem. So if it's, why do you need, like, firstly, you should have a CTO if it's a tech. If you are running a SaaS company, like, you need engineering help. But again, like, there's enough no code tools out there. If it requires an initial website and landing page, that can happen on Webflow on your own. I would also challenge you to see what more you could do there. So I think that's broadly what I will say. Otherwise, it's tough to specifically point out. But one universal thing that works is please speak to your potential customers. Like, please, one way of at least understanding why it's not happening is to just speak to customers. And I would highly recommend this one book. It's called The Mom Test. It's for like 99 rupees on LinkedIn. On Kindle. My bad. It just, I think there's a way to speak to potential customers. We often just go direct and speak about our product first. We don't really understand what their problems are, because there might be things that you're building or working on which are actually not a problem. And it's a bias. So I think if I had to really choose, regardless of whether you have a CTO or not, because I don't know what stage you're in terms of product building, I would certainly do at least 10 of those as one starting point, and maybe get a better understanding from there.
Yeah, so I think that basically points in the direction of customer development, and I think that's a core component before we're starting out on any kind of a business.
I have no affiliation to this book.
I
just cannot recommend enough. I just cannot recommend it enough. Yeah, if anybody can't find it on LinkedIn, please email me for that at the very least. And I'll send you the link, but sorry, from Kindle. And yeah, that's one thing I'd like to add.
If I could just double click on what Jitesh also said, right? That like you can kind of break down the problem into a couple of elements. Either, like he said, the product doesn't seem to be working for the person you're selling it to, or you're trying to sell it to the wrong person altogether, or the pricing is off, or they're just not able to discover your product. So there are a couple of like very you can break this down into sub problems and then go and evaluate each of these individually. So like absolutely talking to your customers is the best way to do that, because they can tell you whether your pricing doesn't work, whether it doesn't solve the demand, or whether they just didn't know you existed. And the latter, or the last one, is also a very common problem that happens. So kind of break it down into sub problems and think about it that way. And to Jitesh's point, yes, that you don't need a CTO to solve this problem necessarily. But when you actually start thinking of fundraising, if you do, team composition is definitely something that gets evaluated. Not that every startup needs a CTO early on, or even needs great tech talent early on. But if you're building a software-led company, having a strong tech team, whether they're C-suite or not, would help in your fundraising as well.
Absolutely, absolutely. And that's what DoDash essentially does. The platform, eventually the target platform, is going to continuously evaluate you on 5 dimensions, or help you evaluate yourself on 5 dimensions, which are essentially on the team, the traction, the timing, the technology / product, and the TAM, which is basically the size of the market. So the next question comes from a gentleman called Shania Sinha. I don't know, gentleman or lady. I'm sorry. The question is around seed funding of ventures started by young or experienced founders. What is your outlook on that?
I think that's inexperienced, young or inexperienced.
So So is age a number? Does age matter to you as a fund?
We invested, okay, one of our first checks, Grey Orange, bits college founders. Till date, the best success story from a hardware company in India. Our Fund 3 investment, Pixel, 22-year-olds, I think, if not younger, building for space. And I think like the founders handle boards better than some very experienced founders. So short answer, no. Radhika can add this, but in fact, I feel like I think I've seen from, if I have to check the data, but I think our average age of founders that we've invested in, I think has dropped over the last 10 years.
Yeah.
If you see a pattern across funds, and we're seeing more and more younger and hungrier founders come in. In fact, like I keep seeing that over and over happening. And Shana is a lady. She just replied on the chat. Yeah, sorry about that from our side. But yeah, I think like we don't really have a prejudice or anything, but I think it's important that you know who you're talking to, what you are looking to build, and have the delusion as we've often mentioned and even on this call.
So, correct my understanding. So you, as a fund, have been investing in younger and younger founders. While this is very interesting because recently there was a study which was published by, I think, Harvard or one of the top universities from the US, and there they did an assessment on, I don't know, several recently funded companies, and the average age of the founders is mid 40s now. This is and more successful companies which are getting investments or attracting investments are much higher. This is quite a difference from what is visible globally. Is
Yeah,
it
we
by
have studied
design,
that.
or is it by design, or is it just a pure coincidence?
It's not by design. It's not by design for sure. It's not that there is a thesis around it or anything of that sort. I think a couple of factors. Once we studied that's article by Harvard where they kind of, as you said, evaluated founders in large numbers and the ones that have done well and kind of looked at what co-founder relationships did well, what the average age was for the best founders. Um, One, I think you can't zero it in with such granularity. Um, we've seen the best pitches in recent times from founders under say 35, and it so happens that we've made those bets. We also have made bets with founders who are older than that, which have also done very well. But I think the difference in the Harvard study and what we're seeing in India, and this is true, what Jitesh mentioned in trends, is true across funds pretty much in India right now. There is also a strong cultural element involved. I think in the US, just small things like college debt is so high, right? So you can't take that risk where you're not making steady income, where you don't know where financial security lies for you right after college, which is where we're seeing a lot of founders deep into their entrepreneurial journeys in India. So that's just one such example. There are many such reasons that make that age a little bit different in India and in the West. But yeah, we're seeing significantly younger founders. I don't think being young or inexperienced in any way will damage your so many of the founders that we've invested in, I think majority of them are first time founders. So in terms of being founders, they're inexperienced. I think the ways to counter for that are build a strong team, build a team that you're comfortable with, get the right partners, and really study the space incredibly well. The two examples that Jitesh mentioned, both Grey Orange and Pixel, are companies, and many other founders that we invested in very early on are founders who really understood the space very well and are extremely passionate about what they're building. The founders at Pixel are incredibly passionate about space tech and what they're building for the country. So I think that kind of really helps counterbalance any element of age and experience or lack thereof.
Thank you for this. Thank you, Radhika. One question which actually there's a combination of questions from two or three people, which I see that most of the venture capital funds write that they invest in early stage startups. And when apparently the experience is when people reach out to them, they say, "Oh, go ahead, you know, get an angel investments, get some angels in, and then we're gonna start having look at you." Or probably they don't even have an MVP or a hypothesis. So the question people are asking is, why do you then call yourself early stage then? And I think this is very important for people to recognize what early stage essentially means. Because early stages doesn't mean that I just had a brilliant idea in my mind and I sketched out two to five slide sheets on a presentation. I prepared a presentation file, but please go ahead, elaborate that.
I can start and would love for Jitesh to add. So there are really only two types of investment we bucket them. There's early and there's growth. And both have several stages to it. So as you said, early stage investing can be raising money from your family and friends when you've just gotten an idea, just quit your job, to raising from external angels, people who are experts in the field, people who've built companies before, etc. Who even with institutional funds, you have funds who will make 200K bets, you have funds who will make 500K bets, $2 million bets, even $5 million bets, who all call themselves early stage investing. Your series A or series B is really where the nozzle starts turning away from early more towards growth. And similarly, growth investing can be anything from 10 million to $1 billion or more. So it's not that early stage investing means that, like you said, will come in the moment you have the idea or the moment you have a product that you're raising for. Even early stage investing has stages. So the best way to know when a fund comes in, most VC funds will have in their website some description around what stage they come in at. So it could be when you've got your minimum viable product, your MVP. It could be when you're reaching PMF. It could be when you're raising a much larger round to start your growth journey. So that would be the best way to understand where we come in. But yes, I mean, contrary to popular belief, we're all early stage investors, from all the way from family and friends to a Series A investor.
So I think that's very valid, Radhika. Obviously, in most of the institutional investors will come in when product market fit has been clearly established, which demonstrates a clear path to revenue or clear path to profitability, if there's anything like that, but at least a clear path to revenue. So there is
just to add, if you don't mind, just to
Yes,
add, I think most VCs at least mention, as Radhika said very clearly, like I remember Nikhil just sent a link about our website where we clearly state broadly, like even down to like revenue numbers of what broad revenue we would like to see. The challenge is like it works both ways, right? Like it's not on me to question the founder saying, hey, you haven't read it. But often that could be the case. But we could be exceptions as well. There are often, broadly, I completely agree. I will just have one point there, and I saw a pattern around questions around MVP, pre-product, and things like that. So I just want to add that to this mix as well. Blume doesn't do MVP or pre-seed investments by default. It's very, 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 very rare that we take them. That's clearly visible in our investment criteria. At the same time, there are many people now, at least in India, early, who do that. Antler is a great example. Antler's just launched their founders cohort. They literally come in, I would say, -1 stage, not even 0, where you may not even have your co-founder in place. So Kishan, who asked, I think he could be a good candidate there. I'm also happy to refer. There are enough and more pre-seed investors coming in actively in the ecosystem who do exactly this. So and they're actually, we work with them. So we will work with Antler, we will work with this First Check. Even we have a founders fund who does small amount of these investments, but not as actively. And that ultimately is a sign of a good ecosystem. And that's how it should be moving forward as well.
Got it. So there's one very interesting question. Thanks for the elaboration first. There's one very interesting question which is coming up, and I think I could already answer that, but I would let you do. Is that, do you invest in startups outside of India as well? Are there any valuation criteria or limitations? I think there is, obviously, being an Indian fund, there are some restrictions in terms of because you're regulated by SEBI, Securities and Exchange Board of India. So there are certain restrictions, but I would let you complete that.
Sure, I'll
What are
take
the
that.
restrictions? How much do you invest in startups outside of India or not?
So we need an India angle somewhere.
Founder.
Founder base in India, selling abroad, all bases in India, selling in India, which means very tough to take up a founder in Finland or Africa solving for a local problem where we have no expertise. The reality is that for us to maximize the probability of returns, we will only do things which we feel we can actually contribute in the growth. For example, Blume does not do D2C brands, not because we can't, but because there's no one on the team who has the expertise, and we don't want to raise our hands and say, okay, I'll fund the next beta. We may do it in 3 years, but not at the moment, right? So to answer this, there's a SEBI limit, by the way, 25% from what I remember.
Correct.
And often what happens is that's total fund size, obviously, but we often leave a large amount of money as follow-on investment capital. So 25% of $100 million fund looks like 25 million, but in reality, it's not, because like in a $100 million fund, we'll do only 25 checks, for example, and leave 70, like 80 roughly, because there's management fees for follow-on investments. So we have done, in fact, a lot of SaaS companies, for example, are set up as Singapore entities and India entities, but there is some Indian connection. They're either having bases in India or have some sort of linkage, which become important for us because that's our strong suit.
Right.
Radhika, anything to add?
Radhika, I'm just kind of trying to go through as many.
Yeah, we're also out of time, so that's okay.
We're just slightly over time. One question which is very, very interesting from Rahul P. What is better, having one investor for 20% equity or 10 investors for 20% equity?
Yeah. I don't get 10 investors. That's a bad idea. That said, there is an answer that's in between. One investor is great if you like the investor, if they understand the space, if you think they'll add value. That's great. There is also a lot of merit in multi-party rounds. So multi-party round is basically where you have more than one VC. I wouldn't dream of getting like 10 different people on my cap table. That's crazy. You will never get anything voted in. But to have 2 or even 3 parties come into your round gives you a very interesting angle there, because you're able to leverage expertise from that many different people. You have that many different sources of capital when you're raising a follow-on round. And the hope that they'll keep trying to one-up each other and helping you, so you will get more helping hands than normal. So I think having a round split across 2 people is very powerful. But I wouldn't go very much beyond that.
If you have interest from one doing 20%, you can easily bring one more.
That's true.
Like,
absolutely.
I don't know a situation where this will not happen.
I think there is another dimension to it, Jitesh. I think the stage of the company is very, very important to recognize. You know, when we are looking at a very, very early stage, where pre-seed kind of a scenario, and where you're not doing a priced round, probably it doesn't really matter, because you could consolidate a lot of investors into a pool, and
then Nikhil, 10 smart operators are far better than one VC.
Exactly.
Right?
So I think you need to be very cognizant of what stage you are in before you embark upon any such journey. Of course, you know, a lot of investors are not likely to participate all in one single entity, because they also need to manage their risks. So we'll probably have one lead investor and then, supporting investors. So there's this very interesting question, and I think Amit Kumar is asking, when should we start ESOPs? What is a parameter of CAC? Oh, these are pretty simple. When should you start ESOP?
I think as early as you can. You should ideally
Absolutely.
start giving ESOPs very, very early on to your best hires.
Absolutely. I think I personally recommend that, have your virtual stock option plan written out probably at the time of incorporation itself. That would be, of course, you can start allotting those ESOPs as and when your people start coming in, but that clearly shows that you're preparing well for the future already. Jitesh, would you like to add something to this?
Your best hires will leave if you don't give them ownership. Very simple. Like, I think it's a mission you come on, and you need an army. So, and that's the only way. Completely agreed.
Right. Uh, then, of course, I have one little question for you, Jitesh, and that is about the mom test. I'm not sure how many people are going to read this book, even after your very strong advocacy towards going ahead and doing that. If you were to take a gist out of this, make it, dumb it down for in a paragraph for our listeners, our audience, that would be great, and that would essentially, we'll signal towards close of our session, because a lot of Germany is playing England right now, so
Oh yeah, I, I can imagine. I now I know why my WhatsApp is also exploding. So I'll summarize it in one paragraph. I'll do you one better, where the book itself has a summary at the end of it. I'm going to put screenshots, and we can maybe put it up on Dudash for wider viewing as well. But to summarize it, the idea is very simple. It just focuses broadly on customer conversations, or how you're trying to understand if you're speaking to somebody about a problem. It starts essentially from identifying, and basically what you need to do is, whenever you're talking to a stranger, ideally, or even your friend, try and understand their frustrations and what they're going through. As founders, we are too emotionally invested in our idea, so it's very easy for you to ask, hey, do you face a problem in fundraising? Oh great, here's Dudash. You don't even ask them if there is actually a problem. They will just be nice to you because they're your friend and say, yes, I do have a problem. So essentially the book is about that the real understanding is not about your product at all. That comes secondary. It's about the problem you solve.
absolutely.
And what you are actually doing should ideally never be part of the conversation.
Absolutely.
Because ultimately people are driven by, it's actually a great psychology lesson overall as well, because then when you start to dig deeper and hence become curious, you'll get very interesting answers. One thing so that's the broad gist of this. When you're approaching questions, I will leave one specific nugget which stuck with me, which I never looked at it from this lens. Often when you're speaking to a potential user just to understand their problem, we often get marred by compliments or just good things because the other person wants to look good, whether this is worth the time or not. Often I feel the real test when somebody says they have a problem is when you ask back, hey, have you done something about it? Most of the problems are just our complaints. We don't do anything about it. A big part of your monetization gets solved by the initial user who says, dude, I have tried 10 things, nothing has worked. I would spend all my time to try and help you. Those are also, by the way, your best early users. Absolutely. They are people who are your evangelists.
Absolutely.
And I started to observe this even when I'm now listening to founders, or when I was doing this otherwise, I would have not done this normally. So if I had to summarize, I think that would be it, but I'll separately share These screenshots of founders done a great job on that for the community as well.
Thank you so much. Thank you so much, Jitesh. And before I'm gonna let you go, one last question to Radhika. And this is a question which is, I think, which is also pretty close to my heart, because I think a lot about food security, and food security somewhere, leads you into agri-tech. There's this question from Anup Ganguly who says that agri-tech is going to be a sunrise sector. I mean, that's what his statement. I don't know. But is Bloom's thesis anywhere? Is it part of Bloom's thesis? Will Bloom
Yeah,
invest in agri-tech?
Yeah.
yeah, absolutely. Yeah, we made a couple of very interesting bets in agri-tech. Jai Kisan being one of the more recent ones that's also doing very well. There are and in multiple ways, right? There are elements of agri-tech that intersect with fintech because there's so much work being done around farmer credit, so on and so forth. There are elements of agri-tech that are involved in like warehousing and more deep tech products around just non-GMO products, fertilization, etc. So yeah, absolutely. Agri-tech is very, very big in Bloom's thesis. We made a couple of bets in the space. It's a space we very actively track. So if you're building something in that space, would love to chat.
Absolutely.
And I agree. It's a sector that's going to do very, very well in India. But we're seeing so much of the population involved in agriculture. So much of our agricultural production happens in within the country. And seeing so much tech adoption happen slowly in the sector. So there's clearly scope for more adoption, more to be built out there.
And I think, and this is one statement which I would like to really make for people who are joining us from Africa. Uh, Keep a close watch on the type of startups which are emerging in India in the agri-tech space, specifically because a lot of it, at least, the environment and the difficulty and the problem standpoint, uh, the situations can be almost not really one-on-one, but nearly the same. And at least that's a good learning point. We used to see that when I used to do my business actively in technology space, I recall we used to use India as a crucible for testing out for what could potentially work in Africa as well. And anything which worked in India pretty much worked with obviously, certain adaptations, homologation, as we call it in automotive, uh, which would work in the US, sorry, in Africa. I'm sorry.
That's
Yeah.
true even like within India in certain states. You see certain states with slightly higher literacy rates, slightly higher tech adoption, especially in the south, will always be a little bit ahead of the curve than certain other states in the north. So actually, you'll see a similar pattern that the northern states should be aware of what's happening in the southern states on agri.
So before I think there's one question which I would really like to take is regarding the product market fit. And I think this gentleman is asking, Jasaro, he's asking that regarding the point you made about PMF, what are the kind of metrics do you look for post PMF? Um,
Yeah.
I have my view on my own personal view on it, but again, happy to hear from your standpoint.
Yeah, I can take a stab at it. Would love for the two of you to add to that. Three broad metrics, and again, I look more at consumer companies, so this is slightly got a consumer bias to it. One, outside of your early adopters who you personally know, so your friends who are adopting the product, not including them, for your other adopters, what is retention looking like? Now, it's hard to give very specific numbers because these depend on industry benchmarks, right? Like retention cohorts for edtech look very different than retention cohorts for, say, a cosmetics company. So look at your industry's benchmarks and broadly, is your retention moving steadily to and then above your industry benchmark? Second, is your LTV to CAC ratio looking significantly better, or in simpler terms, are you able to derive more and more value from the same customer by spending the same, or are you able to spend less money to get the same customer? And third, what is your NPS look like? What are consumers saying about your product? So is your NPS increasing again to industry benchmarks? So that would be the three metrics that would be a good place to start tracking PMF.
I'll just add to that, Nikhil. Radhika's pretty much covered it, but just two other things that at least I feel. I think product market PMF, achieving PMF is also a bit, while it's about the metrics, I think sometimes you just feel it. You just know when you're in that cycle day in, day out. What I've generally tried to equate it as is that another way of saying about the LTV CAC ratio is when people start to sell for you, you start to get more and more referrals. You just all of a sudden start to get more and more testimonials. I'm talking, let's say, more on the B2B side. And you just seeing that happen far, like you can observe and say, hey, 6 months ago, I was putting in the same effort or around the same effort and I had 10 leads. Now I have 50. My closure ratios have increased. Average ticket size increased. Clearly something is working. And that it's a fancy VC term, but flywheel is what we generally call it as. We, as you know, do a lot of these terms just for the sake of it sometimes. But I think that's another thing I'd like to add into PMF. While Radhika covered the more quantitative ones, I just thought I'll cover the qualitative ones.
No, I think that's great. I think with that, we would like to bring an end to this session. We are already about 18 minutes over, and it's getting late for you in the night as well. So thank you so much, Radhika. Thank you so much, Jitesh, for taking the time out and speaking to us and educating our community members. And hope people will reach out to you with their ideas, and maybe something interesting comes out of this process.
Absolutely. Thank you for having us, and appreciate anybody who stayed on as well. Towards the end, whatever we couldn't answer, you can either route it through the Udash team or to us. We're happy to help out. Thanks a lot, Nikhil. Thanks, Nikhil, for even organizing this, and thank you, Radhika, for also taking the time out. Appreciate that.
Thank you, everybody.
Thanks, everyone.
Thanks, and very good night.
Have a